Hello friends, myself Ashley Anthony. Today I am going to take the topic life insurance. I know everyone is familiar with the topic life insurance, so we can go to the topic. First of all, we should know what is life insurance. Life insurance is basically a financial agreement for your dependents. By definition, we can tell that it is defined as a contract between an insurance policy holder and an insurance company where the insurer promises to pay a sum of money in exchange for a premium upon the death of an insured person or after a set of period. Otherwise, we can tell that life insurance is a life cover. In simple words, it can be told as like it is a pay to your loved ones or dependents a specified amount of money in the event of their death. It is there to help ensure that your loved ones or your dependents are looked after and provided with enough amount of financial stability if you are no longer alive. Who should buy a life insurance plans? Nowadays, like new families, young and single adults, parents with minor children, business owners, parents with special aided children, people with a home loan are all seeking a life insurance plans. By taking a life insurance plans, or what are the reasons of taking life insurance for your loved ones? One of the basic reason is after your death, the family will be getting a financial stability, access to cash, there will be an income replacement, there will be a financial protection, estate planning, there will be a lot of health benefits, supplemental retirement income will be there, legacy planning will be there. These are the reasons why insurance is important for your loved ones. So this is basically a life insurance. So next we can move to the principles of life insurance. There are basically 8 principles of life insurance. First one is principle of good faith. This is one of the primary principle of insurance. According to this principle, the policyholder as well as the company who is giving the insurance have to disclose all the information that is related to the risk to the insurance company very truthfully. The insured will be the person who is seeking insurance from the company, and the insurer is the person who is giving insurance to the person. So insurer will be a company and insured will be a person who is seeking insurance. So by the principle of utmost good faith, the insured person should disclose everything to the company. If he is having any medical risk or he is having any other kind of things, he should disclose all kind of features. Similarly, the company, the insurer also should give every terms and conditions about the policy to the insured persons. Otherwise, it can get cancelled if any other facts are disclosed later. It can be medical conditions too. The second feature is the principle of insurable interest. According to this principle, as the term itself says, they should have a interest for taking the insurance, that you must have an insurable interest in the life that is insured. That is, you will suffer financially if the insured dies. You cannot buy a life insurance policy for a person on whom you have no insurable interest. It is of utmost weight. So this is the second principle of insurable interest. Next one is principle of indemnity. Basically, this principle is not applied to life insurance as well as critical health policies, but this is one general principle of insurance. So according to the principle of indemnity, it states that insurance will only cover you for the loss that has happened. The insurer will thoroughly inspect and calculate the losses, and what is the equality it will be paid, nothing less or nothing more. That is the simple meaning of principle of indemnity. And I would like to say that this principle, however, does not apply to life insurance and critical health policies. Next point is principle of subrogation. This principle comes into play when a loss has occurred due to some other person or some other parties and not the insured. In such a case, the insurance company will be having a legal right to reach the party, that party or person who have caused this loss, and from them they can get the recovery. That is the principle of subrogation. According to this subrogation principle, if a third party comes into play and makes a loss to the insured, the company will be directly going to the third party for that recovery payment through a legal way. That is principle of subrogation. And the next is principle of proximate cause. This means that first is first preferred cause. While calculating the claim for a loss that has happened to the insured, the proximate cause will be considered. That is, the cause which is the closest and the main reason for a loss should be considered. For example, for a bike we are taking a kind of insurance, and two happens occurred. First one was an earthquake and second one was fire. Here the first cause is earthquake. Sometimes according to the policy, for that kind of calamities he would not be having an insurance, but for the fire he would be having insurance. But in this situation, which is first cause, that will be considered. Here the first cause is earthquake, so he will not be getting the insurance. That is the first, in this the first cause will be the closest and it will be preferred, and no other reasons will be considered. So this is one of the vital factors in all types of insurance. This principle is not used in life insurance. So principle of indemnity and this proximate cause will not be used in life insurance, but this is one of the general insurance policies. Next one is principle of contribution. According to the principle of contribution, if you are taking insurance from more than one insurer, both insurers will share the loss in same proportion of their respective coverage. If one insurance company has paid in full, it has a right to approach other insurance companies to receive a proportionate amount too. This is the principle of contribution. And the next one is principle of loss minimization. This case is like the insured will be taking a policy from the insurer. It is up to the insurer to minimize the losses. Not only the duty of insurer, insured also should take necessary steps to limit the loss when it happens. For example, if the person is having a smoking habit, his health life is not in a good condition. It is very bad for both the parties, so it will make a huge loss for his life and his family. So it is up to him to take that smoking habit remove from his life. So you must take all the necessary steps to limit the loss when it happens. You must take all the necessary precautions to prevent the loss. The smoking case which I meant is like one of the example, one of the precaution to prevent the loss even after purchasing the insurance. So this is the principle of loss minimization. And the last principle is nature of contract. While making the contract, both the parties, that is the insurer and the insured, will be entering into the contract willingnessly. Due to some kind of compulsion, they should not put into the contract. And the insured person, the person who is taking the insurance, should be having a sound mind without any mental abilities. He should be an eligible person to get into a contract, otherwise the contract gets void, it will not be valid. So the nature of contract should be valid. For that, the both parties should be of sound mind, and without any compulsion they should enter to the contract. So these are the principles of life insurance, or the general principles of insurance. Coming to the life insurance, the principle of indemnity as well as the principle of proximate cause will not be there coming into the principles of life insurance. So next we will be moving towards the types of life insurance. There are several types of life insurance, but major 5 are being explained here. The first one is whole life insurance policy. From the term itself, we will get to know that it is a whole life insurance. For the peculiarity of this insurance policy is that only after the death of the insured person only, the family will be getting the beneficiaries. First point is that sum assured will be paid after death. That is what I meant. The insurer after the death only for the nominees or the beneficiaries will be getting the sum of money. It is a premium for a fixed period or whole life. It is up to the insured person to take up the policy either for a fixed period of time or for a whole life. He can make up the payments. Here premium means the payments he should make up. It can be monthly wise or it can be weekly wise or quarterly. It is up to the person to make the premium. And the policy term till the death of the assured. The policy will be going till the death of the assured. That is the first type of life insurance, the whole life insurance. It is only paid after the death. And the second one is endowment life insurance policy. It is just opposite to the whole life insurance policy. Here the sum assured will be attained at a certain age or fixed period or the death whichever is earlier. He can get the sum of money for a fixed period. There will be, for example, for a 2 year must he have taken the policy, but if the death happens before if the death happens early or something like that, the sum will be given. Or if he wants to use the money before death also, he can use that. It is like providing an insurance cover and savings. Next is the joint life insurance policy. From the word itself, we can know it is a kind of joincy between two or more persons. Here the premium or the payment will be done jointly, or anyone in the group can pay the lump sum or installments. Basically this kind of policy will be taken like husband and wife or the partners in a company can be taken. There may be 4 to 5 participants in that partnership. Anyone can do the payment, that anyone can do the premium, or the 4 of them can divide and make the payments. It is up to them to make the payments. And the sum assured to the survivor upon the death of any one person. There will be sometimes 4 persons in the partnership. If anyone dies in the partnership, it will be given to other peoples. So that is joint life insurance policy. And the next policy is annuity life insurance policy. It is a sum assured attains at a particular age. It can be done like monthly, quarterly, half yearly or yearly. It can be made through single payment or installments. It is basically preferred by people who like to have regular income after a certain age. This is it has no something to do with death. There are some kind of people who would like to have money or who don't want to get dependent on their children. They want to get a sum of money after their retirement too. Such kind of people will be going for annuity life insurance policy. So after a time or after a particular age, they will be getting this amount of money by prescribed by them itself. If they want monthly during the policy making, they should tell after this fixed period of time, monthly wise or quarterly wise, they should get the money. The policy should be made in contract. So according to that policy, they will be getting the money after a particular age. And the last policy is children's endowment life insurance policy. This is basically a policy taken up for the marriage or education of children by their parents. Here the premium is paid by the insurer who is taking the insurance, and here the sum is assured when the children attain a particular age. During the policy making, they will make a contract like at this kind of age the children will be getting sum of money for his education or for their marriage purpose or something like that. So what is the age which is fixed in the contract, at that time they will be getting the money. One of the other important factor in this policy is that if the insurer or the person who is paying the money dies before the maturity, no premium or no payment should be paid thereafter. So these are the types of life insurance policy. So thank you so much for listening to my video. Thank you.